our nearest Travis Perkins down where I live in Kent has closed down. A couple of my friends who work for Travis Perkins have just been made redundant, and so I was very interested to see how they are performing financially. So today we're going to take a look at Travis Perkins PLC. Hey there guys, welcome to the FTSE Show, episode number 50. That's insane. 50 episodes. I should have maybe jazzed this one up a little bit more. Maybe like some tassels on the board or something. Maybe I should have worn something a bit more snazzy. I feel like the content's more important. I was thinking about doing a live stream of me analysing a company. I was going to do that on the 50th episode, but time just ran away with me and I hadn't had the opportunity to set that up. But I'm not really one for tradition or for big numbers or anything like that at all. So I'll do that at some point. It just won't be episode number 50, obviously. Today we're going to take a look at a company called Travis Perkins PLC, who are a very well-known company here in the UK. Builders merchant sort of company. And the local branch, I suppose they're quite a drive away, but the nearest one to where I am in Kent in the UK closed down very recently, and I've even got a few friends that weren't from that branch that have just been made redundant, so there's some trouble going on at Travis Perkins, perhaps. Obviously, what with the events of 2020, that is understandable, but they closed that branch before this all kicked off, so there was trouble beforehand, I believe. So I was very interested to take a look at the numbers of Travis Perkins to see if there are any signs of what's going on, if there's any trouble, if there's, if we knew that this was coming. I had known about Thomas Cook, for example, in 2012 onwards, so it was about 2014 we all knew about Thomas Cook and the fact that things were not looking good, and then every year just looked worse and worse and worse. And then when the media came out and it was like shock horror that Travis Cook had gone out of business, well, it was of no surprise to me in the slightest, because we've been watching the decline for about 5 years. So I was interested to see whether or not there are any some similar numbers going on here with Travis Perkins. So without any further delay, let's go take a look. Okay, let's take a look at Travis Perkins PLC then, Epic code TPK. These guys are in the FTSE 250 and they're in the support services sector. So we've definitely got revenue growth here. This is a company that's able to get out there and find more ways of bringing in customer money, which is a good start. We can see here that we've grown from 2.9 in 2009, 2.9 billion. We've seen that rise to 5 billion by 2013, up to 6 billion by 2015. And we're just knocking on the door of 7 billion now, 6.9 billion in 2019. So that's fantastic, and there's some solid revenue growth there. But of course, revenue doesn't give us the full picture. What we really want to look at is gross margin and the gross profit. And as we can see here, 7% in 2008 is what they were keeping. That's a 7% slice of the pie. If you think of all the revenue as a pie, what slice is the company keeping after cost of sales? Now, cost of sales is essentially the cost of bringing in the materials that they sell and what they do and the services that they provide, and what's left after that. And that's just the gross profit, essentially. And the slice is pretty small. 7% in 2008, 7% in 2010. Fast forward to 2013, we're looking at just shy of 7% still. 2015, 7%, and then the last couple of years we've seen it drop a little bit. We're starting to see some lower numbers, 5.9% in 2017, 5.6% in 2018, back up to 6% in 2019. So we've seen a bit of a jump up in 2019, but it still looks like there's a downward trend from the 8s and the 7s that we were seeing 10 years ago to the 5s and the 6s that we're seeing now. So it's a very slow downward trend, but it is a downward trend nonetheless. Expenses aren't a problem, 45%, it's not an issue right now. Looking at the interest on debt, that's relatively high, at 37% of the operating profit. The operating profit now being 232 million in 2019, but 87 million of that's going on interest on debt alone, so that's a bit high for me. And then when we come down to the net earnings, this is where the downward trend really starts to take shape, and you can really start to see the numbers going down, because if we look at the 5.4% that these guys were making in 2009, down to 4.5, 4.4, 4.3, back up to 5 in 2013, but then 4.6, and then the big jump down was 2015, down to 2.8. First time we've seen some numbers down that low. Then the next year, 0.2%, so they only just made a profit that year. 3.7 in 2017, and then 2018 they made their first losing year. So you can start to see this is a downward trend. There are a couple of peaks, a couple of good years, or good years for them relative to what they achieve. 3.7%, kind of being their good year in 2017. But we've definitely got a downward trend here. 2019, 1.2%. So back to profitable ways, but still really small margins there, really tight margins. 86 million in terms of net earnings for the shareholders, but that 86 million came from nearly 7 billion. So yeah, really not keeping much of the money that's coming into this business, and that percentage that they keep at the end of it, once everything's been deducted, including taxes and interest on debt, all that kind of stuff, 1.2%, very low margin. And again, like I say all the time with these companies with low margins, all you got to have is a big spike in costs one year, and that's it. And that's exactly what happened in 2018. We can see here revenue went up, cost of sales, or if you want gross margin, was at their regular kind of low at 5.6%. So that was a bit of an issue. But then what really killed them was the 386 million in expenses that year. So a big spike in expenses came along, and basically over 100% of their gross profit eaten up in expenses. So straight away we know they've made a loss that year. But once all the other deductions have come out, it's down to nearly an 80 million loss in 2018. So as you can see here, there is an obvious trend downwards. We're starting to see some losing years. We've been very close in 2016. We definitely had a losing year in 2018. We're only at 1.2% for 2019. That's all a concern for me. And these are numbers that would suggest that this is not a company whose share price is likely to be going up. These are all the numbers that we don't want to be seeing as investors, and trends we don't want to be seeing as investors. Current ratio is at 1.3. That's okay, that's nice and healthy. Cash, and those of you that are interested in how much the company actually has held in cash, we're looking at 207 million for Travis Perkins. Assets have been rising, and they've been rising pretty well. We're looking at 3 billion in assets in 2008, now at 6.4 billion in assets. So assets have been going up, but obviously it doesn't, again, it's like revenue. It doesn't really tell you the full picture, because, well, liabilities have probably gone up as well, and they certainly have been. And so what really I like to look at would be the equity. We'll look at that in a moment. Long-term debt, though, first of all, there's no short-term debt here, which is good, but long-term debt there certainly is, 583 million. That's going to take them, based on current earnings, about 6.7 years to pay off. For me, it's just a bit too high. It's not crazy levels. It's not like they're biting off way more than they can chew. And certainly over the last 10 years, they've been operating their debt levels at a level that seems comfortable to their size. However, because earnings have dropped off now, and debt levels haven't decreased all that much, that's a concern for me. We have seen over the last 4 years definite decline in the outstanding debt. 621 million in 2016, down to 612, down to 605, and then last year 583 million. So we've definitely seen over the last 4 years debt levels decreasing, which means there's obviously a focused effort on reducing outstanding debt with the business. But right now that debt level is still too high, and it's going to be difficult for them to pay it off when they're only making 1% margin or having a couple of losing years along the way. So that's a concern for me as an investor as well. Looking at the equity of the business, to kind of send home, I guess, the message here, 2013, 2.5 billion in equity. In 2019, 2.5 billion in equity. So literally over the last 8 years, not a lot of growth. There's been some good years in the interim in between, but we're pretty much where we were in 2013 still in terms of equity in this business. So it's suggesting not a huge amount of growth in that either. Looking at the retained earnings, we were sitting at 1.8 billion in 2014, 1.9 in 2015. We've now dropped off down to 1.7 billion. Over the last 5 years, retained earnings has been down 1% and on average a year. So retained earnings not growing, but falling, reducing, but at a very slow rate. And the return on shareholder equity is only at 3.4%. So it means they've got a lot of assets, this company, but they're not making much return from those assets, as we've seen. So the return on shareholder equity score is pretty low. So what I'm looking at here is a company that unfortunately just doesn't really have too much going for it. Revenue has been going up. That's great. So, good stuff. Gross margin has been at 7-8%, now looking at 5-6%. So we've definitely seen a decline over the last 10 years there. We've got very low net earnings at 1%. This was a company that was making 4-5% a year between 2009 and let's say 2014, and then since then it's just been much worse numbers. The last 5 years really haven't been anywhere near as good as 10 years ago, let's say. So that's a concern for me that we're not growing as a company here. And then, in terms of the debt levels are a bit high for me. The retained earnings isn't growing, and the return on shareholder equity score is poor. So it's not looking great. Not the sort of company I would be looking for. Not terrible. Not one of the worst companies I've ever seen or anything like that at all. Just not a company that's going to be ticking my boxes. Not the sort of numbers that I'm looking for out of a company. Let's go and take a look at their chart. Okay, so better than I thought it was going to be, if I'm honest. Looking at 2008, they were sitting at £9.39, now sitting at £11.65. So in 12 years, we've gone up about, let's call it £2 a share, about 10, maybe 15% in share price value, which, that's about an average of 1 to 2% a year, which isn't what we're looking for. So this hasn't really grown particularly well. They did go through a good period between 2009 and 2015, and that's when we saw those numbers start to decline, didn't we? And we started to see, it's really over the last 5 years, 4 or 5 years, where we've started to see that decline in the numbers, and that we've seen the share price do the same thing, because we reached highs of about coming close to £23 a share at one point back in August 2015, and now we're down to £11 a share. And that is a concern for me, is that we've got downward trends in some of the financials now, and as you can see, those investors that know what they're doing with their money are staying away. There is not much demand for these shares. As a result, the prices are coming down, and they've been coming down for a long time now. So some concerns there. Not a company I would particularly be investing in. We can go and take a look and see how they scored on the leaderboard. Okay, so couple of numbers for you. Travis Perkins trading today at time of recording at £11.65 a share. So looking at the earnings per share then to try and judge whether or not £11.65 is good value right now. Remember, I always say this now, and I want to make it really clear, because some people say to me that clearly they don't get it. We are looking at the financials of a company. Is this company a good company to invest in? Full stop. Are they a good company to invest in? That's what we've just kind of looked at with the numbers. This now is looking at, is the price right? They can be two separate things. So you might have a company that isn't a very good investment, but the share price is really attractive. You could have a company that's a fantastic investment, but the share price is just way overvalued. Or it could be a fantastic bargain right now, And so what I tend to look for is fantastic companies first, and then of those fantastic companies, how many of them are priced right. Travis Perkins, not for me, not a fantastic company in the slightest. But we're looking at the price now. Is the price, some people like buying what they call dog turd companies, but just because they're cheap, and that's a very risky strategy. Not a strategy that I adopt myself. But looking at Travis Perkins, they're trading at £11.65, earnings per share of 48 pence a share. That works out about 4.1%. So if you buy all the outstanding shares in Travis Perkins for £11.65 on a yearly basis, the earnings that they're achieving right now, and that could go down in the future, is 48 pence a share, which is about 4.1% return on your investment, which is kind of meh. It's not, I hate saying that phrase. I don't know why I keep using it. It would suggest that the share price right now is about right on that, just on that measurable. We can also look at the equity of the company, the assets that it owns, or it's the assets minus the liabilities technically. We've got 252 million shares outstanding, but an equity of 2.5 billion. That's very interesting because you've got a huge amount of equity in this company, and this is because at Travis Perkins they have a huge amount of assets but very little in terms of earnings. So they've got all these assets in this company. This is generally a bad sign for me. It's not something that I like. I like companies that can build up assets that are income producing assets. It's not really the case with Travis Perkins. They've got a ton of assets but they're not really producing any income in terms of profit. Yes, revenue's going up, but they're not holding on to the profits, and so that the cost of running this business is too high, and therefore the profits that they're making off the assets they own is very, very small. Hence why the return on shareholder equity score was low in the numbers that we looked at. And so here we've got a company with 2.5 billion in equity and only 252 million shares outstanding. That gives us an equity per share value of £9.92. That's a price to book ratio of 1.1. That suggests that the share price of Travis Perkins at £11.65 is actually really good. But that's purely based on their assets. And you have to look at, this is why I look at both the earnings and the assets within the business to then work out, is the share price right? And with the earnings being as low as 4.1%, that would suggest the share price is too high. The assets suggest the share price is actually really good. And so with those two combined, my kind of gut's sitting on this is that the Travis Perkins shares are a bit too high by a smidge. Maybe I would have preferred to be able to get in at about £9 a share if they were a solid investment. That's it. So really the price is kind of by the by. I'm not really interested in the price. I'm just sharing this information with you just because it kind of adds value in other ways. Some people like to buy these companies purely off the price. If they think the price is a bargain, they'll buy the company no matter how good they are. That's not for me. I like to combine the two. I want a good, solid company that's a great investment, but I want a great price as well. And so when I build my watch list, and I've got 44 stocks on that now, it grows every week as we find more and more companies. Me and my team are finding more and more companies at the moment, and those on my membership program get a weekly report of all those companies. We've got about 44 companies on that list right now, and of those companies, I think we've got about 10 of those companies that are priced right now at a good competitive price. The other 30 are fantastic companies. The share prices are just too high right now, and so I'm not really buying much of those companies right now, and I'm hoping that some of these great companies are going to drop in value and share price at some point in the next 10-20 years, and no doubt they will, with crashes that might come along and stuff like that. And at that moment I'll already know if I want to buy. The day it happens, I'll know if I'm a buyer. I'll have a price target that I'm looking for, and if it hits that price, I'll be buying as much as I can afford. And that's what I'm really waiting for on those stocks. But there are 10 stocks right now that I am buying. Unfortunately, Travis Perkins are not part of the watch list. They're not a company I would be looking to invest in. The share price is a little bit too high as well. In addition to that, a dividend of 1.3%, so they're not even a dividend company. We are not going to be adding them to the board. If you saw last week, we lost Royal Mail, the last company with minus numbers off the leaderboard, which means that any company that does not make it above 0 on the scoring algorithm do not make it onto this board. Travis Perkins scored minus 75. So, yeah, too many downward trends, too many concerns there for me, and they do not make it onto the board this week. So with that, thank you so much for watching. I hope you're finding these episodes and the delving into these numbers useful, interesting, maybe even entertaining in some way. If there are any companies that you would like me to take a look at from the FTSE, strictly the FTSE, any market, any index, it could be the FTSE 100, the 250, the small cap, the fledgling, or the AIM market, any companies you'd like me to take a look at, leave them in the comments below, and I will do my best to get to them at some point in the future. Otherwise, thank you for watching. Thank you for celebrating the 50th episode of the show with me. And yeah, let's hope for 50 more, I guess. Thank you so much, and I'll see you next week. Cheers, guys.